Hello there, so today's video is about EPR Properties. The big news we're going to be talking about is the dividend that is returning. I'll be telling you how much it is, when it's starting, when you need to own the shares by to get it, and of course what dividend yield it will work out at. We'll also look at other things which I will explain to you later so that you know where EPR Properties is likely to go in the future. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit the subscribe button down below, hit the notification bell, and then you get notified every time I release a new video. And if you like this video and found it useful, please do remember to hit the subscribe button, because that helps the YouTube channel, which in turn helps me, and of course I do appreciate it. So I've been requested to do an update video several times now. The last one I did was in February 2021. So for all those people who've requested it, here it is, here's the video. And if anyone has any requests for other videos, please do leave me comments down below. I do read every comment and I do try to reply. And I would love to hear your thoughts on EPR Properties and where you think it's going to be in a few years' time. At the end of this video, you'll get to see where I'm projecting it to be. You'll see the 3 possible outcomes that I forecast so that you can see. I'll also show you the Wall Street analyst forecasts as well for the next 12 months. So you'll get to see all of that in this video, but I would love to know what your thoughts are, where you think it's likely to go, and if this is a share that you're buying, holding or selling. And at the end of this video, of course, I will be telling you my opinion anyway. So with all that said, one thing I need to warn you of is I am not a financial advisor. This is not financial advice. You need to do your own due diligence and research before investing in any stocks and shares. There you go, you have been told. Okay, let's move on to the slides. So this is the July 2021 update on EPR Properties. So what we will cover in today's video, I'm going to give you an update on EPR Properties. We're going to talk about the return of the monthly dividend. We're going to look at the historical share price trend. We're going to do an overview of recent financials, and it's just going to be a basic overview. I'm then going to look at future forecasts. We're going to talk about what I'm doing, whether I'm buying, selling, holding, and why. So first piece of news, cinemas, they're back. As of June the 30th, 2021, approximately 99% of EPR's theatres are now open. The stay-at-home orders and lockdowns and other restrictions are being lifted around the world, and obviously in America as well. If you're in the UK, you'll know tomorrow is officially Freedom Day, the 19th of July. Apparently life will return to normal according to our boss Boris Johnson, bless him. So we shall see. But I've spoken in previous EPR videos. If you've not seen my previous EPR videos, by the way, I'll put a link up there and a description down below, because I've gone through this particular stock in absolute massive detail. So if you're new to EPR Properties, I would recommend you check out that playlist. I'll like I say, a link up there and in the description down below. Check out the playlist. You'll learn everything you need to know about EPR Properties, and you'll see where its share price has been as well. So you'll be able to see what my forecasts were, which I'm very pleased to say so far have been coming true. And like I say, at the end of this video, you'll get to see my forecasts moving forward from where we are now as well as. But obviously, I spoke in one of the previous videos about the political standpoints and how the political leaders, if you like, don't want to be seen to be letting people die. I think the next phase now is the political leaders are really looking to try to open back up, and it's who can recover the economy the quickest, if you like. And I think, if Britain goes ahead and does that, America will be watching, the EU will be watching. They will not, America's competitive. They're not going to want to be outdone. The EU hate Britain doing anything better than they do. So basically, I believe everything is going to start to open up unless something goes wrong with the opening up in the UK or any of the openings up, basically. But I think as long as the vaccines do their job and death rates stay low, essentially, I personally think the opening up will continue and life will return more or less to normal. There'll still be certain restrictions for a little while, but I think over time, as I said in previous videos, eventually it will all pass. And of course, that's going to be great for the share price. But let's have a look at this now. So obviously, the stay-at-home orders, restrictions, lockdowns are being lifted. 98% of EPR Properties non-theatre locations were also open from the 30th of June 2021. And as I said already, vaccines have increased consumer confidence, which obviously means people are feeling happier about going out. And I think there's a lot of pent-up demand as well, where people have been trapped indoors for a long time and they're actually keen to go out. They want to go and do experiences. And like I say, I'm not going to go through the experiences that EPR Properties offers, but there's a wide range. Check out my previous videos for that and you will see it's not just theatres that they do. Rent collections are improving. For the second quarter of 2021, the company collected approximately 82% of contractual cash revenue. This cash collection level is in excess of the high end of the previously announced guidance for the second quarter, which was of 75 to 80%. So they've beaten what the projections were. Now, I'm expecting them to release their Q2 results at the end of July. So probably sometime in August, I'll do another video on EPR Properties where I'll go through them reviews and we'll look at how they actually did in the second quarter of 2021, because I think that's going to be more interesting than how they did in the first quarter, because we'll get to see what was happening as things were opening. I actually think the really interesting quarter will be Q3, where it's how they do once things have actually all opened, which we know they have all opened essentially now. So that's where I really want to see is the Q3, and I'll do, of course, another video for that. So if this is a stock you follow, subscribe to the channel if you've not already, and you will be able to see the videos as I release them, because I do keep following this stock and keep you updated on the progress of this stock. So the monthly dividend is back, and yes, it's a monthly dividend again. If you watch the channel already, you know I literally made a video literally just like last week of all the monthly dividend stocks that are paying dividends in 2021. I'm already out of date, look, there's now another one. So this is another monthly dividend stock paying monthly dividends, which will be coming back very, very soon. I'm going to go through that in a minute. If you've not seen the full list of monthly dividend stocks video, again, I'll put a link up there and in the description down below. So if you are interested in other monthly dividend stocks, feel free to check that out, and hopefully that'll give you some other ideas as well. So here's a press release from EPR Properties, as you can see, on the 13th of July 2021. And you can see the company announced today that its board of trustees declared a monthly cash dividend to common shareholders. The dividend of 25 cents per common share is payable on the 16th of August 2021 to shareholders on record for the July 30th 2021, and represents an annualized dividend of $3 per share. So I want to point out the early termination of covenant relief period, which is to do with the loans and what they're borrowing essentially. And basically they've decided to terminate that. They've reduced down the revolving credit facility, and the key point here is where it says it's a reduction of approximately 100 basis points on the revolving credit facility and term loan, and 125 basis points on the private placement notes. What that actually means is their borrowing just got a whole lot cheaper, which can improve their bottom line or profit, because obviously it's essentially a landlord. So like any landlord, it borrows money in order to buy assets that then generate an income. And if that borrowing is expensive, the profit is less. If the borrowing is cheaper, the profit is higher. It's as simple as that. And that is essentially what has happened there. They've managed to get that down, and so that's why I'm pointing that out. That is a good thing. So monthly dividends, so it's going to be 25 cents per month per share, paid from August 2021. At the current share price, which is $53.49 per share, that gives a dividend yield of 5.61%. Now if you'd have bought it at $24 per share, that would have given you a dividend yield of 12.5%. Why do I say $24 per share? Because that is the exact price I was saying we should be buying it at back in October 2020. If you watch my previous video from October 2020, I'll put a link up there to that and in the description down below, you will see what my prediction was then, and you'll see that I was saying then this is a good price to be buying at. First dividend is to be paid on 16th of August 2021 to shareholders of record on July the 30th 2021. If you're curious as to what I'm actually making on mine, I actually hold this in two portfolios. In one portfolio, my cost base average is $27.70, which gives me a dividend yield of 10.8%, and in the other portfolio I have a cost base average of $35, which gives me a dividend yield of 8.5%. So next, let's take a look at the historical share price trend. So we're looking at the maximum share price trend chart here. You can see it had a low in 2009 of $12.79, which it very quickly recovered from. You can see over the next couple of years that shot back up to a similar trading range. It then sat in a trading range of $37 to $60 from approximately March 2010 until December 2015. It then increased to a new range, hitting a high of $84.46 in January of 2016. Obviously, March 2020 came along, and just like the rest of the stock market, we had an almighty crash, and it went down to $17.05. And as you can see, since then, we have had somewhat of a recovery. If we look at the 5-year share price chart, you can see that it was in a range basically from December 2015. I know that's before this chart, but I looked at a previous chart to know this. So from December 2015 until March 2020, it ran in a range of between $53.18 to $84.46. Then obviously March 2020 happened and it dropped down. And the reason I've extended that bottom line that you see there is so that you can see we're now just touching the bottom end of what it's normal trading range was. And when we go through the financials in a minute, that's an important thing to remember. I'll be referring back to this, so try and remember this little point. The 1 year share price, so this is what's happened in the 1 year share price. As you see, we had the big dip in 2020. That's when we had all the AMC news and everything was going wrong and the theatres were going to go broke. That was what was happening then. That was October 2020, and that's what caused that dip there in October 2020. Obviously, since then, since November, we had a rapid climb until March 2021. We've then essentially sat in a trading range from March 2021 until the end of May 2021 of between $45 and $49. You see it then broke out of that trading range, and if we look at the 6 month chart, you can see it was in a trading range of between $51 and $56 per share from the 1st of June until the current date, basically. And if we just look at the most recent month, you can see it was bobbling along in its range, and then you'll see on the 13th of July 2021, the exact day that they announced the return of their monthly dividend, that is when you can see it rocketed up, and it has since pulled back a little bit, so it's basically stayed in pretty much a similar range. Next, we're going to take a little look at the financials. So we're going to have a quick overview of the financials. I'm not going to go too in depth in this, just a quick glance at them. The reason I'm not going to go too in depth really is because I don't think they're going to tell us a great deal. Until I see Q2 and Q3, it's Q3 that I'm really interested in, because it's Q3 that's really going to show us what they're collecting when all of their things have been open. And we know that from the 30th of June 2021, basically everything's been open again. So they should be collecting everything. So we should be expecting that to be as good as it was prior to the entire pandemic. That's what we're really hoping for there, in my opinion. So that's where it'll really start to tell some. Just because I know people have asked, I'm going to have a quick glance over the numbers and point some key things out now. So we'll have a little update on that now. So this is the annual income statement for EPR Properties. You can see 2016 all the way up to 2019 was climbing. It fell, as you would expect, in 2020. But notice that the trailing 12 months is actually down on total revenues. The operating income essentially follows the same kind of trend. And if we take a look at the net income there, you can see the loss in the trailing 12 months is bigger than the loss in all of 2020. So, that's not exactly great news as far as I'm concerned. You can see the revenue per share has fallen off in 2020 and in the trailing 12 months. And you can see that the basic earnings per share was a loss in 2020 and a bigger loss in the trailing 12 months. However, if I change that to quarterly, so it's the income statement again, but we're just looking at the past 5 quarters now, you can see the total revenues obviously dropping off, but you can see them starting to climb again. So you can see the last quarter of 2020 was higher, the first quarter of 2021 was higher still, and that's why I'm so keen to see the Q2 and Q3 results. Obviously the Q2 results were obviously good, otherwise management would not have reinstated the dividend. There's no cause to reinstate a dividend if you're not making a profit. They need to make a profit to reinstate the dividend. So we can know certainly for sure they're going to have made some kind of profit in Q2. Otherwise, why they reinstate the dividend? If they reinstate the dividend without making a profit, something is not quite right. So Q2 must have made a profit, but we haven't got that data yet. And I really want to see Q3's profit to see how that compares to what it was previously. But let's have a little look at what we have got now. So you can see March was substantially better than December and obviously way better than Q3 of 2020 in terms of total revenue. And of course, again, for operating income, you can see it was essentially double. And if I scroll down and find the net income there, you can see we went from making a loss in the second quarter of 2020, third and fourth quarter of 2020, to making a small profit, albeit much smaller than it used to be in the first quarter of 2021. So we're expecting that in the second quarter of 2021, that's going to have been increased to be much bigger. And if we then take a little look here at the revenue per share, you can see that has dramatically increased. And the basic earnings per share, while still a loss, it's a tiny loss, which is what leads me to think that in Q2, that's going to be profit and not a loss. And that is basically what is going to mean that they can say, right, yep, dividends coming back, which they've obviously announced, and everything should hopefully go onwards and upwards from there. But let's look at the balance sheet. So here's the balance sheet. And again, I'm looking at this quarterly. And this is the thing I don't like. See the total real estate assets. Can you see them falling there? So they've literally been going down and down and down and down. I don't like that. That's not good. And if we look at the total assets, again, they're going down and down and down and down. Again, I don't like that. That's not good. What I do like is that the total liabilities are also going down and down and down. So let's take a look at the stockholder equity. And you can see that has fallen, but not so bad, but it has fallen nonetheless. If you look at the book value per share, I think that's quite a telling little number there as well. You can see that's actually been falling as well. That's due to the actual assets value falling. If they go up, then the book value per share will increase as well. And I just want to quickly glance over how that looks annually. So look at the total real estate assets there. We're still higher than we were in 2016 and in 2017, but lower than 2018, 2019, slightly higher than 2020, December 2020. If you look at its total assets, you'll see its total assets are slightly higher than they were in 2018, but lower than they were in 2019 or 2020. If you look at the total liabilities line there, you can see the total liabilities are lower than they were in 2020, but about the same as they were in 2019. So if we now look at the total equity, you can see the total equity is pretty much the same as it was in the end of December 2020 and marginally lower than it was in 2018, but it is lower than it was in 2019. And if you look at the book value per share, it is actually slightly higher than it was in 2016, but lower than it was in 2017, 2018, 2019 or 2020. In terms of the actual asset values to the share, they're saying that they've got less assets value per share. So actually the share price is kind of overpriced in that respect in relation to its assets. If you looked at my Owl Rock Capital video that I made previously, I'll put a link up there and in the description down below to that. That was selling pretty much at book value, therefore would be good value to buy. This is trading above its book value, which tells you that the investors that are investing in it are very confident about it. Now, we looked at the historical share price trends earlier, and it always has traded above its book value. So that's an expected thing. That seems to be normal for this particular stock. It's a high yield stock, it's a high income stock, and it owns assets that are property assets that will over time go up in value in prime locations, which is probably one of the reasons it trades above its book value, as most stocks do, to be fair. But the reason I want to point out that its book value is lower than it was, say, in 2019 is because whilst its book value is lower than it was in 2019, I think it's realistic not to expect its actual share price to return to its 2019 levels. And if they do, you know, be a little bit dubious about that. If you want to see the book value go up as well as, you know, when the book value is $39 per share, then sure, the share price should be able to go up proportionately as well. That's all I'm saying there on that. EPR Properties forecasts and possible outcomes. I've got 3 possible outcomes for you as well as the analyst forecast, so we'll go through them right now. So here's the analyst forecast for the next 12 months. They're actually predicting it be $53.80 per share, which is a 0.58% upside over the next 12 months. You've got one analyst calling a buy, 4 rating as a hold. So overall it is rated as a hold. You've got a low price of 49, a high price of $62 per share, and an average price of $53.80 per share. So here's the first of my possible scenarios. This one really assumes that it goes back to its original trading range and then sits in that same trading range as it traded in before, the $55 to $84 per share trading range, $70 per share just being smack in the middle. If you notice, when we looked at the share price charts, it tends to go in a trading range, stay in a trading range for a period of years, and then jumps up to the next trading range. So assuming it goes back to its previous trading range, assuming that Q2 and Q3 are good and that happens, then this is what could potentially happen, and this is also assuming that they do not increase the dividend beyond what they have already announced. So this is assuming it stays at 25 cents per share from now until 2025. This is how much money you could expect to make. Assuming you buy at $53.49 per share, the current share price, and bought $10,000 worth, you would get an annual dividend of $560.85. Now by 2023, assuming the share price rises to $70 per share, you would have a capital of $13,086.56. You would have made dividends in total of $841.28, which is a capital gain of 30.1% on your capital, plus 8.4% total return in earned income via dividends, which makes an average of 25.67 per year total return. Not too bad, right? By 2025, $70 per share, so assuming the price is still in that same trading range, So your capital obviously is the same. Your dividends are obviously greater because you've had more time to collect dividends. So you've made, again, 30.09% gain on capital plus 19.63% dividends earned in income, which makes an average of 14.21% per year total return. Not too bad at all. Okay, so this second scenario basically assumes that the dividend stays the same as they've announced, at $3 per share until 2023, and then at some point in 2023 increases to $4 per share, which is very realistic because if you remember, before the whole pandemic, they used to pay $4.60 per share. So it's not unthinkable that they will get back to that level in, a year and a half essentially, or 2 years. So in a year and a half to 2 years' time, they go to $4 per share, which is lower than it used to be still. And if that happens, I'm also then assuming that the share price will carry on up. So we'll go to $60 per share for 2023 and $70 per share for 2025, which of course is much more realistic, if you like. If the dividends have gone up, the share price will follow suit as well. So assuming that happens, here's how much money you could expect to make. So if you're buying at the current share price of $53.49 per share, you've got $10,000 worth of shares. You're going to make $560.85 in dividends per year for the first year, of course. By 2023, we're saying it's increased to $60 per share, which would give you a capital gain of 12.17% on your capital. You would have a dividend income of 8.41% in total earned over that period, which makes an average annual return in total of 13.72%. Assuming the increase goes ahead at some point in 2023 to $4 per share, that would mean your new annual dividend would be $747.80 per share. So on today's purchase price, that's a 7.47% return, and we're assuming that happens from 2023 onwards. By 2025, we're assuming that then pushes the share price up to $70 per share, which I think is very realistic because it's back in that old trading range that it was in previously. That'd give you 30.1% increase in capital, plus you would have earned 23.37% of your capital back in dividends, as well as making an average annual return of 15.27% per year, which of course I think is very good indeed. And you can see at the bottom there, I've written my assumptions. So now we're going to look at a slightly more positive scenario. We're going to assume again that the share price increases to 2023, increases again to 2025, but this time in 2025 we're going to the high end. We're going to $85 per share, so we're assuming it's going to be pushing at the top of what its previous barrier was and potentially looking to break out sometime after that. We're going to again assume that the dividend is returning, and which we know it is, at $3 per share, and then it will be increasing near the end of 2023 to $4 per share. That is the assumptions we're making this, and if that happens, this is what you'll make. So at the current share price of $53.49, if we bought $10,000 worth, we would get a dividend income of $560.85 per year, which is of course a 5.6% dividend yield. We're assuming by 2023 the share price has gone up to $60 per share, which is very realistic. That gives you a 12.17% gain on capital. You have made 8.41% in income from dividends, which makes an average annual return of 13.72% per year. It's going to beat any bank for sure. We're then assuming this possible dividend increase in $4 per share at some point in 2023. That, of course, at that point, if you're buying at today's prices, means you've then got a 7.47% return on your cost basis per share, which is great in terms of annual dividend yield. And we're assuming that by 2025, you're looking at a share price value of $85 per share. That'd give you a whopping capital gain of 58.9%, plus you would have made 23.37% in dividends earned in income during that period of time, which makes an average annual return of 23.51%, which is absolutely fantastic. I think you'll agree. I've written the assumptions there at the bottom, so the dividend is coming back at $3 per share, and if it then increases to $4 per share from the end of 2023, and that will be a dividend yield of 5.6% on dividends per year to begin with, but would then increase as the dividends increase based on today's purchase price. So this final potential forecast, is the most optimistic. It assumes that not only does the share price increase and the dividend that is being reinstated this year stays the same until the end or late 2023. We're assuming that sometime in 2023 or the end of 2023, it actually goes back to $4.60 per share per year, which is what it was prior to the pandemic and all of the issues that have gone on prior to being cut. So if it goes back to that, this outcome shows you how much you'd make. Now, I'm not saying that this is necessarily going to happen. The reason I've included this is because clearly I was too cautious last time. And if you look at my previous videos where I've made my previous forecasts, I well under-egged it. So this time I'm literally looking at it going, well, you know, will they bring it back to where it was before? Because if they do, this is what would happen. They've brought it back at a higher level than I'd anticipated, which I think is a good sign because it actually shows that Q2 was probably very good. When we get the results, we'll know for sure what actually happened in Q2. Like I say, when that comes out, I'll make a video about it. But it hasn't come out yet, so we don't know. But obviously they know what the results of Q2 are, and we know it's a good management team. We know it's a prudent management team, and they've chosen to increase dividend or bring the dividend back at a higher rate than I expected them to, which is obviously a good sign, which is why I've included this forecast, because if it pans out as it possibly could, then this really shows how much money we could stand to make as investors buying at today's rate. So let's have a look at this. So if you buy at today's shares price of $53.49, again, I'm assuming we buy $10,000 worth, that gives us our $560.85 per year, or 5.61% dividend yield. Then assuming that we get the share price increased to $60 per share, which I think is very realistic, by 2023, you've got your 12.17% gain on capital, plus you're going to earn 8.41% in dividends, which make an annual average return of 13.72% per year, which is obviously beating any bank still. Possible increase in dividend to $4.60 per share at the end of 2023, assuming that happens, is going to make $859.97 per share. Now note, on today's share price, that gives you a dividend yield of 8.6% basically, which is phenomenal. Then you've got, by 2025, I'm assuming that it's the $85, which is the breakout end of its high level before. So that's assuming we're just getting ready to increase from there, which would be high share price for this particular stock. That would give you a capital gain of 58.9%, plus 25.61% in dividends would have been earned, which make an average annual return of 24.25% year on year, which is obviously phenomenal. That assumption's there at the bottom. Dividends being paid from August 2021, which we know is happening at $3 per share. That's already a given. Then we're making the assumption that after that there's an increase to $4.60 per share from the end of 2023. Of course, that may or may not happen. That's just an assumption there. That would give a dividend yield, obviously, of 5.61% in dividends per year, which would then increase, and that would actually increase to an 8.6% dividend yield on today's share price. So I hope that all makes sense. So now, what am I doing? Am I buying, selling, holding, and why? So my thoughts: the dividend returned higher than I had expected, which is obviously a good sign. The share price is now near the lower end of its usual longer term trading range. I believe people like to have experiences, so personally I do believe in the long term for EPR Properties. I would like to see it continue to diversify away from cinemas still. I know they have been doing that, but I still would like that. I still think it's a good potential comeback play, and I still think there's potential room for recovery, as you've just seen in the examples I've given you there. My investing plans for EPR Properties: I'm going to hold the current shares. I'll consider buying more on any dips, but like I said, I'd really like to see the Q2 results first. Ideally, I'd like to see the Q3 of 2021 results so I can really get a feel for how it's going. My intention is to hold for many years, for 20 plus years, so really whatever price I buy, it won't matter too much. Of course, buying now is going to essentially mess up my cost basis on what I bought it at before, but I was buying it incredibly cheaply before, so that doesn't bother me too much. I'm more concerned with the fact I already own quite a lot of shares in this, and I'm not sure I actually want to have it as much of a bigger position in my portfolio right now. I do expect there to be recovery in 5 years for good capital growth and dividends over the long terms. And I will say, as a general side note, the entire stock market as a whole has increased quite a lot recently, but I actually don't think there's going to be a massive crash. I know there's lots of investors and people out there making videos even saying there's going to be a massive stock crash. There may well be a crash. There's always going to be a crash at some point in time. But over the longer term, certainly the next 20 years, I think my view is share prices are going to go up for all shares. If you've watched my video that I made about assets, how assets will make you rich, I spoke there about inflation, and there has been a lot of money printed in America, in the UK, in Europe. All the major economies of the world have been printing money like it's going out of fashion. That increases the value of things in relation to those currencies, and stocks and shares with tangible assets such as REITs like EPR Properties are one of those things. I'll put a link to that video up there and in the description down below if you want to see more about that. I spoke about the value of a Mars bar, was I think the example I used in that particular video, where I was explaining how it goes up in relation to actual currencies. So yeah, so feel free to check that out. But yeah, I think over the long term, this is a good stock. I think it's one that's going to make a nice income. I like it's a monthly income. I particularly like it as a type of REIT because it's experiential, and I personally think that experiences are the future. I like that kind of thing. I think people are getting more and more into minimalism, but are also really wanting to have experiences more than actual things, if that makes sense. I think things are becoming worth less to people, or valued less, if you like, not necessarily worth less, but they're valued less, whereas memories and experiences and things that people do are things that people want nowadays. I think we have so much stuff these days. So that's basically my synopsis. I've spoken more about that in depth in the past, so if you watch my previous videos on EPR Properties, you get a feel for that. Anyway, I really hope you found this video useful. Thank you so much for taking the time to watch this. Have a nice day, and bye-bye.